Thanks, Rob. And just before I start with the, I guess the content of the presentation, I'll just hand over to Chris to give a bit of background on Aither if some of our listeners aren't familiar with Aither.
Yes, look, thanks, Erin and Rob and John. Yes, I'm Chris Olszak, one of the founding directors of Aither. Some of you may have heard of us, but I want to provide a bit of a background on us so you know where we're coming from. Aither is a private advisory business. We have team members across Australia providing strategic, economic and policy advisory services across water, the environment, infrastructure and primary industries. Our company's purpose is to help our clients across government and the private sector make better decisions about challenging issues. We thrive on helping navigate complexity and dealing with uncertainty. Importantly, we have no financial stake in any water market outcome, so we are independent advisors, and our analysis is supported by credible evidence, solid economics, and data-driven insights. In the water market, we provide water market intelligence advice and monthly reports, portfolio strategy and optimization assessments, valuations, and we assist with transaction due diligence. Much of this draws on our water trading and water market database and analytics that we've built over the last 8 years. Many of you will be familiar with our freely available annual water markets report, which is available on our website. It's released every August. And if you are interested in this topic and want more information, then please feel free to reach out to us afterwards. I also wanted to acknowledge the traditional owners of the land of which I'm on today and pay their respects to their elders past and present. And a big thank you to Ag Victoria and to DELP as well. A couple of the reports that we're going to be talking about today were commissioned by DELP. And I know that both DELP and Agricultural Victoria are very committed to providing information to irrigators and water users about what's happening in the market and the changes that are occurring. So we think that's really important and I appreciate the opportunity to be here with you today. Erin, I'll hand back to you.
Great, thank you, Chris. And yeah, just to reiterate our thanks to Rob and the team at Agriculture Victoria for the invitation today. So we'll head into the content of the webinar, and we'll just start with a little bit of a roadmap of where we'll go today. And I guess the webinar is essentially, separated into 2 key parts. And so the first part, we'll look at drivers that are influencing water allocation markets over the recent past. And we'll think about this in terms of, 3 key drivers. The first one is to look at the influence of changes in water supply. We'll then consider how changes in water demand are also influencing what's happening in the market. And finally, we'll also look at the limits to moving water between valleys that are starting to play an increasingly important influence. And really, that last one is a supply side question for the different trading zones. Once we get to that point, we'll take a bit of a pause and take a few questions before we head into the second part of the presentation, which is really looking ahead at what does all of this mean when it comes to where the water market might be heading over the longer term. And so that part of the presentation is really focused on some recent modelling work that Aither did for the Department of Environment, Land, Water and Planning. And within that part of the presentation, we'll also look at 3 key trends. And so one is this idea about how different prices in different zones have started to emerge in the recent past, and we expect that to continue into the future. The second one is looking at the fact that allocation prices are also likely to be higher in the future than they've been in the past, but we'll also continue to see variability from year to year. And finally, when we're looking forward to where the water market might be heading, ultimately the biggest driver of water allocation prices is going to be the future climate sequence. And before we get into the content, just want to sort of position this webinar in the context of the next webinar. So in today's webinar, which is looking at where is the water market heading long term, we're really going to take a bit of a helicopter view of the key trends and drivers that are influencing water markets and what they mean for the years ahead. And then in the next webinar, which is titled Understanding and Managing Water Price Volatility on the Farm, that's really an opportunity to consider how these trends and drivers of water markets can actually inform decision making down at the farm level. Okay, so the first trend that we'll look at in terms of water allocation markets is the influence of changes in water supply. So the first key message here is that ultimately water supply varies considerably from year to year. So what this chart shows is in the 13 years since 07-08, how much water has been allocated to the major entitlements in the southern Murray-Darling Basin. And so this includes both consumptive entitlements available for irrigation as well as environmental entitlements. And ultimately, water availability varies considerably. If we look at one of the higher bars on this chart, 16-17, and many of you will remember that as being a very wet year and in some instances some flooding. And in that year, there was just under 7,000 gigalitres allocated to major entitlements. But if we head back to the millennium drought and look at 07-08, there was just less than 2,000 gigalitres allocated in those very dry years, that extreme drought. So to sort of put that in context, our most recent estimates of the horticulture water use is around about 1,200 gigalitres in the connected Murray and Goulburn, with some additional up in the Murrumbidgee as well. And so later in the presentation, I'll talk through some of the results we've got around that supply and demand balance. So if we've got variable water supply, the next key point there is really that water allocation prices respond to those changes in water supply. So if we take the same chart and we drop in some price data, these green dots show the annual volume weighted average price right across the southern Murray-Darling Basin. And in years with very low water supply, prices tend to be higher than in the years where we get a lot more water allocated. So if we look at those 3 years that we looked at before, in 16-17, the prices are a lot lower than what happened back in the millennium drought. And we get the same sort of pattern if we then look at a smaller time step, which is our monthly volume weighted average prices. But one of the key observations on this chart is really what's happening here at the right-hand side. So what we've seen is supply conditions over the last 2 years were really about the same as what they were in 2009-10, but we actually get quite different price outcomes. So average prices have been a lot higher in the last 2 years than what we might have typically expected given the amount of water that was actually allocated. And there are really two key reasons for this, and we'll explore these in detail shortly. But the first is the fact that water available to irrigation has really declined due to the Commonwealth Water Entitlement Purchase, or the buyback program. And the second is that we've also started to see changes in water demand across the basin. So essentially, which industries are using water and where are they using that water? So we'll take a quick look at water recovery. And so water recovery does reduce the water available for irrigation, and in turn it increases water allocation prices. So what we're going to look at here is the estimated impact of water recovery on water allocation prices in the southern MDB. And these results come out of some of the modelling work that Aither did for DELP. Now, when we're looking at trying to test the impact of water recovery on water allocation prices, what we do is we essentially run the model twice. In the first run of the model, we include the observed or what happened with government entitlement purchases. And then we run the model again, but we assume that no water recovery occurred and everything else is essentially held constant. And so then the difference between those two model runs shows us not only the direction of the impact, did they increase or decrease, but also the potential magnitude of the impact. So when we do the first model run, which is our recent or our observed water recovery scenario, we estimate that the average water allocation price across an 11-year period from 2007-8 through to 2017-18, that average water allocation price is sort of just over the $200 mark. Now that's an average across years and regions. But the result we get for that second model run, where we assume that water recovery did not occur and we hold everything else equal, we estimate that the average water allocation price is around $150, $148. And look, the effects will be larger in some years and regions and smaller in others. But ultimately, that gives us an estimate of the difference. That's $58 between these two price estimates. And ultimately, look, this makes sense that there would be an increase in water allocation prices due to the water recovery. Ultimately, with water recovery, water entitlements are being removed, and therefore the water that would be allocated to those entitlements from the consumptive pool. And so that increases water prices because we've effectively reduced the water supply to consumptive users in the market in all years. But that's just a bit of a run through of changes to water supply. Before I move on to looking at changes in demand, Chris, would you like to add anything to this part of the discussion?
I guess the point to add there is that this is based on modelling work. There's a reference and a link to the modelling report which shows the modelling assumptions and approach in a whole lot of detail. I'd note that our results are very consistent with some recent work done by ABARES, and also consistent with a number of the previous academic studies that have been done on this topic. So, but you do need to be careful about the interpretation of the preciseness of which modelling works around some of these numbers. But the general indication is pretty clear and consistent across these studies.
Okay, so the next trend we want to look at is just around how changes in water demand are influencing water markets. And so just at a bit of a high level, when we think about agricultural change across the southern Murray-Darling Basin, there's really sort of, I guess, two key trends here in terms of water demand. And that is we've seen the introduction of cotton growing into the Murrumbidgee as new cold resistant varieties have been developed. That's become viable in that particular valley. And then we've also seen the expansion of permanent horticulture in the southern Murray-Darling Basin, and that's particularly concentrated in the lower Murray, in that tri-state area below the Barmah Choke. And so just like we've just been through in terms of the potential impact on water allocation prices from water recovery, we'll run through the same analysis, but what we're looking at here is how that demand growth from cotton and permanent horticulture has influenced water allocation prices. And so we basically run the same two model runs again, where we run the model once, where we include the observed increases in water demand for cotton and permanent horticulture. And then we run it again, where we assume that the water demand from cotton and permanent horticulture did not change from the starting year, which in this case is 2007 and 8. And so that's really the only assumption that sort of changes. All other agricultural activities in the model are able to expand and contract their water use in response to modelled market conditions. And so if we look at what happened under the recent demand or observed scenario, again, we get that average allocation price of just over $200. In the second model run, where we hold that demand from cotton and perennial horticulture constant, the estimated average allocation prices is around $161. And so that gives us sort of an average price impact of $45. And again, these are average prices across years and regions. The effects will vary across years and different regions. And again, this also makes sense. The increase in water allocation prices that we see here is really driven by the increase in demand or the willingness to pay for water by cotton and permanent horticulture. So
the kind of takeout from this first assessment when we look back historically is that both the Commonwealth Water Recovery Initiative and changes in demand have both affected where median prices are now and will be going forward as a result of these changes. So what we have is these fundamental changes on a supply side and a demand side that have influenced the market over the last 10 to 15 years. Back to you, Erin.
Thanks, Chris. So we'll return to some of our modelling results, which take a bit of a future look ahead. But before we do that, we'll just take a closer look at some of the demand changes that are happening in the Southern Murray-Darling Basin. And so what we'll look at here is the second report that our results are released in. And again, this was done for DELP and released back in June last year. And the report is also available on the Victorian Water Register website. And so look, the objective of this particular piece of work was to generate an estimate of water use from permanent horticulture in the Southern Murray-Darling Basin and how that compares to potential water supply conditions under different allocation scenarios. And so what this analysis does is it highlights what could happen if three things take place. If the permanent horticulture plantings that are currently in the ground, if they mature, they'll be needing more water. If we then also factor in the fact that there are other planned developments as well that might be implemented. And it also assumes that there's actually no offsetting reduction in other horticulture. So that's something that's quite important to keep in mind when we interpret these results. And to do this work, we work with the three governments, so Victoria, New South Wales and South Australia, to access the best available data to generate these estimates for the connected Murray and also the lower Murray. And what I'll go through now is really just focus on that lower Murray region. And if you're interested in the broader set of results, then I'd encourage you to head to the report and you can see the full results there.
Erin, just before you do, I'm just going to answer a quick question that's come to me directly on the chat, which is from Gavin McMahon, about whether those differences in the historics are additive. And it's an important question, which I should have mentioned before. No, they're not. You can't add the difference due to buyback and the difference due to demand change together to get a total difference. I won't go into the details of that, but it's the way that the modelling is set up and non-linearities within that modelling framework, which means you can't add those two factors together. So I just wanted to clarify that.
Great, that's fantastic. Thanks, Chris. So in terms of the results that I'm going to go through now, when we're looking at the supply side of the equation, we generated 4 different water supply scenarios based on allocation history data. And so looking along the bottom axis of this particular chart, we've got 4 scenarios ranging from a wet scenario, which was based on actual allocations in 2011-12, right through to an extreme dry scenario, which was our 07-08 millennium drought conditions. And these supply estimates are the water available for irrigation or for consumptive use. So we've excluded environmental water holdings for this analysis. And so what you get here is you get, as we pointed out before, there's extreme variability in water supply across the basin. And you see this here, whereby under a wet scenario, there could be about 1,500 gigalitres allocated to entitlements below the choke. So that estimate is based on allocations to our South Australian Murray high security entitlements, our VIC7 high reliability watershares, and our New South Wales Murray high security and general security just in zone 11. But if we get allocation, or if we get supply conditions similar to what we saw in the millennium drought, the total volume of water allocated below the choke might only be around 500 gigalitres. So we get a within region water supply difference of 1,000 gigalitres. Now, what we just need to note here is that these supply estimates, they don't account for water that irrigators might have carried over from one year to the next. And they also don't account for any intervalley trade that might occur to increase the water supply in the lower Murray. And so ultimately what this analysis shows, and we'll work through this in the next couple of slides, is that those two mechanisms, our carryover and our inter-valley trade, are going to become increasingly important for all irrigators in the southern Murray-Darling Basin. So if we slot in our water use estimate, it starts to give us an indication of sort of that supply water use balance. And one of the key takeaways from this particular chart is if we look at the far right hand side under those extreme conditions, our water use from permanent horticulture could outstrip the water supply in the lower Murray by 2.5 times. And that estimate of permanent horticulture water use, around about 1250 gig, it does actually include a little bit of annual horticulture, mainly vegetables, in the New South Wales and Victorian sunraysia. With the data we were working with, it was quite difficult to completely exclude all of that. Nevertheless, it's sort of around 1250. And so then what we can do is we can essentially sort of fill in the gap, and the light blue shows us how much water is allocated sort of over and above that permanent horticulture water use. And so the key takeaway here, as I mentioned before, is really that carryover and inter-valley trade will continue to be important risk management tools for all of the irrigators right across the connected Murray. Because when we look at the equivalent of the connected Murray water supply and water use balance, is the water allocated generally exceeds permanent horticulture water use in most years. So that's this chart here. And so you can see under our 3 wettest scenarios, our wet, average and dry, there's quite a bit of extra water that's allocated to all entitlements across the connected Murray and Goulburn when you compare that to the permanent horticulture water use, which right across the connected Murray we estimate to be about 1350 gig. But again, if we look at the far right-hand side of the chart, under those very extreme dry conditions, then that water supply and water use balance is still quite tight across the connected Murray. So again, it just reinforces that point around carryover and inter-valley trade that are going to become increasingly important in the future. The other point here as well is that it also starts to show how the limits to being able to move water between valleys will continue to influence water markets and drive price differences that we've started to see emerge, particularly in the last 18 months. So our third trend that we'll look at before we take a few questions on the first half of the presentation is that in recent years, we've started to see that the limits to moving water between valleys is influencing allocation markets. So look, we'll briefly review each of the 3 key IVTs and then explore what's happened to allocation prices. So first up, if we just consider the Goulburn, and this one is of particular interest at the current point in time because of the review that the Victorian government is currently undertaking on the trade rule. And so look, with the Goulburn, in recent years, what we've seen is that there has been very high volumes of water traded out of the Goulburn and into the lower Murray. And we saw that in 2017-18 and then in 18-19. But last year, in 19-20, at the request of the Victorian government, interim limits were put in place on the volume of water that could be delivered down the Goulburn River. And that was in response to emerging concerns around some environmental degradation in the lower Goulburn. So what that meant was the volume of water that was actually traded out from Goulburn into the lower Murray was a lot lower last year than what it had been in the 2 years prior. And essentially those arrangements are still in place as we're in the 2020-21 water year. And so yes, the Victorian government is still undertaking a review of the trade rule, and they have said that there'll be no permanent changes made until at least the 1st of July later this year. And while ultimately the outcome of the trade rule review is not yet known, over the longer term, it certainly seems that the volume of water that will be traded from the Goulburn into the lower Murray will probably more closely reflect what happened last year in 2019-20, rather than those high volume years in the 2 years prior. So we'll take a quick look at the Barmer Choke. And look, the main story here is that over the last few years, it has been closed for very long periods of time each water year. This is because water needs to be back traded or traded upstream in order to open up to downstream trade. And so look, while there have been small openings for downstream trade, generally they're pretty fleeting. And then if we look at the Murrumbidgee IVT, again, what we've seen over the last couple of years is it has been closed to downstream trade for very long periods each water year. But look, it can reverse, and this is really dependent on annual production in the Murrumbidgee and also water allocations in that valley. And look, many of you will remember 2017-18 when the IVT actually reversed and it was closed to upstream trade. Okay, so that's some recent trends in terms of the IVTs. And when we look at what that has meant for prices in the different zones, the first thing to note is that in the recent past, we've seen new highs in the lower Murray, not really seen since the millennium drought. And this chart shows a weekly volume weighted average price for allocations in the lower Murray. And the highest VWAP that we saw in this time series was back in November 2019, just under $1,000. So when we compare that price chart with the price chart for some of the upstream zones, and we can see that water hasn't been able to be moved around as easily, and that's really pushed prices higher in the lower Murray than what's taken place in the upstream zones. So this chart shows the influence of the Barmer choke by looking at the difference in the weekly volume weighted average price between the lower Murray and the upper Murray, which is now our blue line. And the largest price difference that we saw there was back at the start of last year, just over $400. If we head to the Goulburn, again, we get a very similar pattern in prices, in that our Goulburn prices simply don't get as high as the lower Murray because of the supply and demand dynamics. And the largest price difference between the Goulburn and the lower Murray was just over $300 back at the end of 2019. And then if we turn to the Murrumbidgee, again, we get a very similar chart pattern here. And the largest price difference between the Murrumbidgee and the lower Murray was just below $250. And that was at the same time we saw that largest price difference in the Goulburn back in October 2019. And so when we present these all on the same chart, we can see that these price differentials have really been a feature of water markets since the start of the 2019 water year. Prior to that, water allocation prices were generally sort of equal across the different trading zones. What we also see here is there's also a general order to the water allocation prices as well. And so if we look at the chart in terms of where prices started to come off that peak about 12 months ago, our green line, which is the lower Murray, tends to be the highest all the way down. It's then followed by the Murrumbidgee, which is our purple line. The Goulburn is our light blue, and the upper Murray is our dark blue. Although, if we look at the period of time sort of in the last 5 or 6 months, reflecting those very high allocations we've seen in the Murrumbidgee and the fact that they came through quite early, our Murrumbidgee prices over the last 5 or 6 months have actually been the lowest of the 4 zones. And look, ultimately, we're sort of always going to get these variations, which are driven by differences in water availability in each part of the market. And this is going to be a key trend that we'll start to look at when we head into the second part of the presentation, which looks at where the water market will be heading over the longer term. So that brings us to, I guess, the midway point of the webinar, which is probably a good point to pause and ask a few questions. So, Rob, how are we going with the questions that are coming in?
I do have a couple of questions, Erin. I'm not sure if Chris would just like to recap or if Chris has any points before we go straight into the questions.
Oh, look, I do. I'm happy for you to go to questions, Rob, and I'll come back to a couple of things.
Yep. Question from Ben Dyer. is it reasonable to put the full cost increase onto water recovery? What about new crops increasing demand with very high returns?
Well, that's exactly what we've done in this report. We've actually tried to tease out the differences and which of those and look at both of those drivers. And what we find is that both of those drivers, their reduced water availability and the increases in demand, are both material and driving increases in prices. So that's exactly what the work has done, is to show that both factors are contributing. It's not just one or the other.
Great. Another question from Alistair Lawson. Is estimated demand same in wet and dry years?
No, so the use in different industries differs in different years, and this goes to a question that came to me directly as well. So the demand profile is calibrated to pick up the fact that water use and land use in irrigation, particularly in the annual crops, varies from year to year. So we pick that up, that natural variability of how much gets planted in wet years versus dry years, and then we add in the growth in cotton and the growth in horticulture and see what difference that makes on top of that moving background from year to year, if that makes sense.
Yep, definitely. Thanks to Ben and Alistair for those questions. I've got a question just on the last graph showing the supply and demand in the lower Murray, and in the dry season it was showing that the demand could be met by the supply, allowing for carryover and intervalley trade. Just wondering how you estimated carryover, the volume of carryover and intervalley trade in that.
So let's go back to that slide, Erin, because there's a couple of points there. And so just to be clear, what we've done if we go to the lower Murray one, the previous one, we've not included any carryover or any intervalley trade. So you can see there's a deficit there in the extreme dry year. The only way that will be met is from trade from other zones, so from the Goulburn and above the choke or the Murrumbidgee, or through carryover from the previous year. So that analysis doesn't include those two things, and that's why we're saying they're important. If horticulture is going to get through a repeat of an 07-08 drought, and let's not forget that was extremely dry. It was a lot drier than what we had last year, which was dry enough. It needs that facility of carryover from the previous year and some intervalley trade to contribute and help make that up. The other point I'd like to make on that chart and this work in general is that this just assumes a horticultural demand. We estimate how much horticulture would use if the water was there. There's a whole different question around where they get it from, even below the choke. So if a dairy farmer holds entitlement and they don't want to sell regardless of the price, then the dairy farmer gets to keep their water. There's no obligation to sell it to a dairy farmer. So I think that's a really important thing to note around this work and the way that it works. It's trying to be quite a simple analysis of what is the current horticultural use. And again, that varies from year to year, depending on whether it's a hot, dry year or a wetter year. And how does that compare to the total amount of supply available? How the market then plays out is a pretty different question. The other thing is, what does it do? What happens to horticulture? And do some of the existing plantings actually drop out because they can't meet the demand or they can't find the water in the market? We haven't modelled how much horticulture might drop out over time in that dynamic. It's trying to keep it simple and information that people can understand in general terms, but there's a whole market overlay that's quite complex and uncertain. We've modelled what we presented, what is clear and known.
Great, thanks, Chris. I'm just a bit aware of the time.
Yeah.
Yep.
Let's keep going.
Okay, so looking ahead, we will consider what the key drivers of supply and demand and the limits to moving water between values, between valleys might mean over the longer term. So we're going to look at three key trends, which I highlighted earlier on. The first one is that different prices in different zones will continue. Allocation prices will likely be higher in the future, and they will still continue to vary from year to year. And then also that the future climate sequence will be the biggest driver of water allocation prices in the future. So what we'll present over the next sort of 10 or 15 minutes is really focused on the results out of our modelling report. We've already presented some of that content already, but this is sort of the forward-looking aspect of that. And look, ultimately this work really helps us understand what might happen to water allocation prices over the longer term. In the report, we present several different scenarios and the potential price outcomes under those scenarios. Today we'll focus on one particular scenario, but just because we're focusing on that doesn't necessarily mean that it's any more likely to occur than any of the other scenarios. So if you're interested in that extra level of detail, I'd encourage you to head over to the report on the Water Register website. As Chris pointed out before, when it comes to our water market model, it's designed to approximate current and future real-world processes, and it is based on the best available information at the time of the analysis. But ultimately, it uses sort of simplified mathematical and statistical representations of really quite complex real-world processes. So while model outputs provide us with insight in terms of where the water market is going over the longer term, ultimately, real-world outcomes may diverge. The other point just to note here as well is as we go through this next part of the content, we're mainly going to look at median prices. And so what these are estimates of the underlying water allocation price trends for a given scenario. They're not annual predictions of what prices might be. So it's quite an important point to keep in mind. So when we talk about water allocation prices being around $250 a megalitre in 2020, we're not saying it's going to be $250 a megalitre. That's really a central price. So the way to think about that is if we run the model 100 times, then 50 times the prices will be higher and 50 times the prices will be lower. So just as we've seen in the recent past, the price differences between different zones will likely continue into the future as well. And so what our modelling results show is that median prices could be between $300 and $370 a megalitre across the southern Murray-Darling Basin. And so these price outcomes are based on a particular scenario, which is our medium demand, low supply scenario. And so the four key underlying assumptions of that scenario is that no further consumptive water recovery will take place, that there's an element of permanent horticulture demand growth that will occur. We'll also see a continuation of a recent climate, and that is that we'll see a repeat of water allocations and rainfall over the last 15 years. So what we know about that climate sequence is it's been very much drier than a longer term climate sequence. And this scenario also includes an approximation of how the IVTs work. So we consider this to be a plausible sort of central case, but as I mentioned before, we're not suggesting this is any more likely to occur than any other scenario. Nevertheless, it does provide some insight around how these price differences will continue to play out across the basin. And so under that medium demand, low supply scenario, what we see is the highest prices as a median are actually in the Murrumbidgee, and our lowest prices are in the Goulburn. And ultimately, these differences can be explained by the trade constraints. The other observation on this slide is that our Murrumbidgee median prices are actually higher than the median prices in the lower Murray, which might come as a bit of a surprise. But the way we can explain this is that Murrumbidgee demand is actually relatively high compared to the water supply in the Murrumbidgee over the last 15 years. And we've also had the limits on trade into that region as well. The other aspect where trade constraints play a role in these price outcomes is really for the lower Murray. While the median price is lower in the lower Murray than in the Murrumbidgee, what we actually see is that in some years, the prices in the lower Murray are actually considerably higher than what they are in other trade zones. And this really reflects the fact that the demand in the lower Murray is dominated by our permanent horticulture. And so in severe drought conditions, when supply is severely reduced, there's a lot of upwards pressure on allocation prices in that zone. And ultimately, yes, intervalley trade can help relieve some of that pressure, but there are limits to what that trade could be. And so prices are not always equalised across the zones. So moving on to the second key trend here, which is that allocation prices will likely be higher in the future, and they will continue to vary from year to year, as we are familiar with. So what we'll look at now is, rather than just a single price for the modelling time horizon, we're going to look at median prices over time between 2020 and 2035. And when we look at those prices across the 4 zones, again, we see there is that variation across the zones, and a median price in 2020 is around about the $250 mark. And they might increase up to between $400 and $450 by the time we get to 2035, depending on which zone you're in. But again, just to sort of reiterate, again, we're not predicting these as definite annual price outcomes. Ultimately, they are central prices, and 50% of the years prices will be lower, and in 50% of the years prices will be higher. But ultimately, the key takeaway here is that because of those changes in supply and demand that have taken place over the last 10 years, so that's our water recovery and also what we're seeing around horticulture development, that's locked in, and that's going to influence where we go in the future. So alongside the fact that prices simply might be higher in the future, they're also going to vary from year to year in response to different supply and demand conditions. So to help talk through this a little bit, we'll look at a couple of different scenarios here. So we've got our 4 zones along the bottom. And if we drop in our median price results for our central case, which are the prices that we looked at before when we had the map up, and then we change the scenario, and we throw in a scenario that looks at a low demand versus in a high supply scenario. And so in this particular scenario that's represented by the dark blue charts, there's no further consumptive water recovery. There's no growth of permanent horticulture. And quite critically, it's a return to historical climate conditions. So in this scenario, we're actually using the long-term climate record, which is a lot wetter than what it's been over the last 15 years. And so we can think about this particular scenario as potentially being a bit of a lower bound on future water allocation prices. If we then move the scenario in the other direction, whereby we look at a high demand and a very low supply scenario, prices do then increase a little bit from that central case. And so this high demand, very low supply includes 500 gig more of further consumptive water recovery. It also factors in a lot more growth from permanent horticulture, and it also retains our recent climate assumptions using the last 15 years. And just in terms of the final trend, and this is the final part of the presentation, where we'll look at the fact that it's the future climate sequence will be the biggest driver of water allocation prices in the future. And ultimately, one of the key questions here is, in the midst of everything that is changing and shaping water markets, what matters the most is ultimately the question that we'll explore now. So to do this, we'll look at first our price results for 9 different scenarios if we assume the recent climate will continue into the future. And then we'll look at the same set of results where we assume that the historical climate will continue. And on this matrix here, we've got 3 different demand scenarios and then 3 different water recovery scenarios. And so if we see a repeat of the recent climate and we factor in a known demand profile from permanent horticulture, along with a little bit of extra consumptive water recovery, 100 gigalitres in this particular case, the median water allocation price comes out at just under $340. When we drop in the price results for either side of that central case by adjusting our recovery assumptions, we can see that if we take more water out of the consumptive pool, we do get a corresponding price increase there. And median allocation prices might increase up to near $400. Then if we look at the other axis on this particular matrix as well, we look at adjusting our demand assumptions. Again, if we get an increase in demand coming online, that is also going to have an influence on prices. But the key takeaway here is the fact that our difference in terms of changing the demand assumptions is actually less than if you change the water supply. And finally, if we sort of populate that full matrix, what we can see is with those 9 different scenarios, prices may vary between sort of $300 under a low demand, no more water recovery scenario, up to around $400 if we get a high level of demand growth and additional water recovery. And finally, let's look at how those price results play out if a historical wetter climate sequence continues. If we drop in our central case there, what we see is that the price result comes out actually under $200 compared to our $339 over here under a recent climate. Again, we see the same sort of pattern if we change our assumptions around water recovery. Under a historical climate, we still get an increase in water allocation prices. And likewise, if we alter our demand assumptions as well, again, we get a change in water allocation price there. But the pattern still holds in that the difference in additional consumptive water recovery tends to be greater than the difference when it comes to changes in demand. And then if we populate that full matrix as well, price results vary between 135 in the top left-hand corner to 276 down in the bottom right-hand corner. So ultimately, in summary, when we compare the prices between the 2 matrices, the key point here is that the largest price differences are actually between the 2 matrices, not necessarily within each one. And so when we refer to the fact that the future climate sequence is the biggest driver, there are really 2 key aspects of this that we need to keep in mind. The first is that inflows over multiple decades will vary from year to year, just as they have in the past. And this alone will be enough to drive water allocation prices. But second, there's also likely to be the climate change overlay, which may exacerbate those price outcomes. So ultimately, one of the key takeaways here is, yeah, changes in water recovery and demand, they do matter, but ultimately it's that climate sequence that will matter more. So the other 3 trends that we wanted to share with you today around answering this question of where the water market is heading in the long term. And I think we've got about 5 or 6 minutes to head to a few more questions, Rob.
Okay, Erin. Thanks for that. There is a question here from Anthony McCloskey. Are there any modelled forecasts for commodity prices to compare to the modelled water prices?
Yes, there are. So our modelling and the report, which you can again find on the website, does include assumptions about the future of commodity prices, and also we can shock the model with changes in commodity prices. So if you think that the dairy price is going to increase a lot, or the cotton price is going to increase or decrease, we can model those factors around how they might play out in terms of these price differences. So that's highlighted again a really good point, that there's a number of things that drive these model results. We've used published information around commodity price projections and current levels of commodity prices, as well as yields and productivity. And a lot of that growth is due to, in prices over time, is due to those natural improvements in productivity, which a lot of the research from ABARES and others has pointed towards improved productivity over time as well. So that is, it's another driver and another dimension of the analysis that can be undertaken.
Thanks, Chris. I'll just point out to participants that the evaluation poll has gone up on the screen, and if people could answer those ticker box questions, that would be much appreciated. On one of your slides, Erin, you had water recovery at I think it was 0, 100 and 500 gigalitres. Just interested in your thoughts about the probability of that extra water recovery happening in the future.
Yeah, absolutely. It's a good question. And I guess there's been a couple of key events sort of more recently around this. And, you know, the current federal government's position is that there will be no more buybacks. But obviously, no current government can actually hold a future government to maintain a particular policy position. So that's, I guess, part of the answer. Chris, do you want to follow up with anything further on that?
Yeah, I guess we've been very cautious not to assign any probabilities to those scenarios. We've taken a couple of numbers around potential future recovery. There's obviously a huge policy debate around the rollout of the basin plan. We're not in any way jumping into that or saying that, you know, any of those scenarios is likely. What we wanted to do is look at the price outcomes under those potential scenarios, but not indicate which ones were more or less likely. And obviously, it's a very political question or a policy question that needs to be resolved.
Great. And I think I can just slip one more quick question in. Just about the physical movement of different enterprises into different regions. For example, do you see horticulture expanding in the Upper Murray or Goulburn?
Yeah, look, potentially, and we've seen some evidence of that already occurring. We've also seen some horticulturists looking outside of the southern Murray-Darling Basin as well for land that's suitable for permanent horticultural development, has the right climate and soils and access to markets, as well as cheap water. So there's certainly been, I think, a response from investors in permanent horticulture to say, well, with water prices increasing so much and entitlement prices increasing so much in that southern or in the lower Murray area and the Sunraysia area, where else can we go? And they are looking for that mix where all the conditions are right and the cost to develop land is economic.
Thanks, Chris and Erin. The clock's wound on to 2 o'clock, so I'm pretty keen to wind it up. But thanks for an excellent presentation. It was very informative, and I think you've made a very complex subject as simple as it can be. I'll just remind people of those reports that Erin and Chris put up on the screen, and also that this recording will be sent out to webinar participants, so you will be able to look at it again. Thanks very much to everyone for joining in and for your contributions. Thanks to John for his technical assistance, and just a reminder that the next webinar coming up on the 25th of February. So thanks to again Chris, Erin, John, and everyone for being part of it, and I hope you have a good afternoon. Thank you.